Hello, everyone, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the deferred sales trust, is the best way to exit your highly appreciated assets tax deferred so you can create, preserve, and grow your wealth. I'm your co-host, Pearson York, filling in for Brett Schwartz. And each episode, I'm joined by some of the best wealth, business, real estate, and leadership individuals in the world, where we share ideas, deals, stories, and inspirations. So together we can make complex tax deferral strategies simple and passive income plans achievable. As always, we are streaming on the Expert CRE Secrets podcast, expertcresecrets.com, the Capital Gains Tax Solutions YouTube channel, the Kingdom Luxury Realty Facebook channel. And please rate, review, subscribe, hit the like button, notification bell, all that kind of good stuff, so you guys can get updates and never miss an episode. And I'm super pumped for our next guest. This guy's done over $1 billion worth of real estate, and he's just a wealth of knowledge and wisdom. Chris Larsen, how you doing, Chris?
Pearson, I'm great, man. Great to see you.
Yeah, awesome. So tell us a little bit about how you got in. What's your story?
Yeah, man, I started when I was still in college, age 21, bought my first residential property, and you're out in Newport Beach. So, I mean, I think your property taxes are about what I paid for that first property. It was $90,000, a 3-bedroom townhouse in Blacksburg, Virginia, near Virginia Tech, where I went to school. And I thought that was the way. I thought that was like the best way to do it, was buy several residential properties, rent them out, pay them off over a period of time. It was a simple plan, but I ran out of capital. So I went out and I got a real job, quote unquote, real job. I spent 18 years in the medical device industry, and I really fell in love. I got to work with neurosurgeons, orthopedic surgeons, and got to work with technology that I studied in my undergrad and my engineering program. But I got to work in the OR, and I was able to generate a lot of capital to continue to buy properties. But about 10 years ago, my wife and I transitioned from residential properties to commercial properties. And that's why I call multifamily commercial property the holy grail in my book, which I think you have the link down here. If you want to get a copy of it, you can check us out, nextlevelincome.com/book, and I'll even send you a copy.
Awesome. So, Chris, how did you go from medical sales to full-time real estate? So honestly, because that's exactly what I did. I was in medical sales, device, DME, that type of thing. And, there's still a little piece of me that's like, man, that's a good gig. Like, do I really want to give that up? How did you make that transition?
Yeah. So you probably can relate. And my buddy said when I left, he's like, what do you hate money, Chris? You don't want to keep making good money. So the thing is, Pearson, it's a mindset. And look, if you're listening today, you have a similar mindset. You have to think like an investor. And I always thought like an investor. I wanted to be an investor, and that's what I did. I just didn't have the capital to do it. And then, when you get pulled into the corporate world, especially sales, which, I'm sure a lot of people, either business owner sales, you get pulled into this world and it's alluring. It's like, oh, you make President's Club, you make $100,000 and $200,000 and $400,000, you're making more and more money. And it's exciting. There's titles that are bestowed upon you sometimes along the way. You're chasing a career track. But ultimately, when I really thought about it, my boys are 10 and 12 now. So, the answer to your question is, I started out as an investor, but I left that career because my father died when I was 5. And I didn't really get to have the experience of time with him. And I didn't want to miss my son's lacrosse games. I didn't want to miss, the time at the dinner table, or, sitting there in the mornings with them, kind of those magic moments. And yeah, I walked away from, some potential success there in my career, but ultimately have been able to build a community and, our own business around the syndication world with respect to the commercial properties. But I couldn't have done it if I hadn't have invested in this space in the first place.
Yeah. No, that's super interesting. So really what it came down to is just you were tired of trading your time for money.
That's exactly right.
It's you just saw the path to time for you.
That's right. No, that's exactly right. And really, I talk about it in my book. I say, you have to look, whether you're a sales professional, you're a business owner, you're an entrepreneur, you're an investor, you have to look at, is your model scalable, right? The single family property model, it's scalable to a point, but nobody really wants to manage 50 or 100 properties, like when it comes down to it, and but
Oh,
yeah, it's a pain in the butt, right? So it's not scalable. Like, do you really want to be chasing down rent from 100 people every month, or do you want to put a manager in place that can manage one property with 100 doors in it, like our first property we bought, my first partner and I, that can do that for you? That's much more scalable, and if you can scale your time, you can actually control your time. You can control the results a lot better as well, and there's ultimately less risk if you do it that way.
Yeah. So why do you like multifamily so much?
Yeah. So I think, look, I wrote my book 5 or so years ago, and I updated it here a couple of years ago, right before COVID hit. And I still think that the demographics that I write about in the book, the statistics that I put in here, I call it the rising tide. So, I like to invest and be in areas of the economy, of the market. And I talk about this called page 68 here in the book. You can see the demographic trend increase. It's the same reason I got in the medical device space. The baby boomers are the most active, most affluent generation in the history of the planet, as far as we know. Though we go back and say, who built those pyramids? Maybe they were even more impressive than we realize today. But okay, so you had this super active, super affluent generation. They're going to continue to be active. They're going to want to have surgery so they can preserve their quality of life. I thought, hey, this is a great area to go into. When I first started studying multifamily, I found that the baby boomers' children, the millennials, were going to be the largest renting generation in the history of the country. Same thing with the baby boomers. They're actually, as they retire, they're downsizing. And the baby boomers, as you probably know here, Pearson, fastest growing renter demographic right now. So you combine their children and them and immigration on top of this, and you just have this rising tide of demand. Also, what happened after the Great Recession was we just basically stopped building. We weren't building enough homes. We weren't building enough apartments. And even though there's this building craze right now, we're still struggling to catch up, which is why I like multifamily so much. It's performed admirably. Now, we started to look at other areas as well, but the bulk of our personal portfolio and what we do continues to be multifamily for those reasons.
So yeah, this brings me to this question. And how has your perception, if it has at all, changed as you start looking at these other asset classes and start thinking, okay, how are these returns? What's my maintenance like, right? What's my costs, all that kind of stuff. How has that shifted as you started going into other asset classes?
Yeah. So kind of focusing on multifamily first, I think we have to be cognizant that last year, 2021, was the best year by almost any measure for multifamily in history. So, we had just record rent growth, we had record occupancy, we had record cap rate compression, all these things, right? So if you look at it over a 10-year span, it's kind of like the stock market. If you're like, hey, the stock market's going to average 10% a year, but you have a 30% year, well, at some point in time, it's probably going to be, negative 10%, right? These are just things that we know. So if multifamily has a blowout year, we expect some moderation, going forward. That being said, I think if you look at 10 years ago, I was a big fan of workforce housing. Today, what we found is, and I think this, continues from this K-shaped recovery as we've come out of 2020, right, with COVID. What's happened is the higher quality properties, so your Class A properties that have been built in the last 10 years, those are in higher demand. And the reasons are, again, you got to go to the fundamentals. You got to go to the underlying economic reasons. We didn't build enough starter homes. The number one reason we lose renters, we lose residents in our Class A properties because they go out and buy a house. Well, if there's not enough homes and housing prices have increased and interest rates have gone up, what are those people going to do? They're going to continue to rent. So I've gone from, workforce housing, like 70s, 80s vintage properties, to, properties that are built in the last 10 years being more favorable. And we started positioning our portfolio about 2.5 years ago, pre-COVID, into those sorts of properties. And again, those are going to be less risk. They're going to have a more stable renter population. They're going to have lower costs. So if some of my investors were like, how can your overhead, how can your overhead be so low in these properties? And the reason is you just don't have to turn them over as much. You don't have this as high maintenance, and then also less risk. So I think that's a positive thing in uncertain economic times.
So you basically just went from like class like C to class A minus A properties that are new, and so there's not, they're not falling apart yet, and all that kind of stuff. Are you getting the same sort of returns? Are you guys just doing cash flow play, or what's the business strategy there?
Yeah, I think it really depends on the markets you're buying in. So there are certain properties, like if we buy a brand new property in a great market like Charlotte, for instance, we may not expect to have quite as high returns as if we go into, maybe a more tertiary market, or if we have, a little bit more of a value add play. So, if a property is 10 years old and you can pump $10,000 or $15,000 into it and see 20% rent growth in that property, you may have better returns, obviously, than a brand new property, that's fully occupied, that sort of thing. But what we found last year was these properties have had the same or even better returns than some of those workforce properties. But I don't have a crystal ball. But again, I think decreasing risk right now is a positive in my mind.
Yeah, definitely. So are you guys buying at what kind of cap rates are you guys buying at?
Yeah, I think across the country, I think if you look, the average cap rate for this type of product is in the fours, like 4 to 5%. There's certainly markets below that. We're not in those markets where they're in the threes. Yeah.
LA.
If you get to, yeah, LA, Austin's been off the charts. And when Austin was in the fours, I was like, that's too low. Like, we're not going there.
Yeah.
And, just they keep going down. So that's because you guys, right? Your neighbors, maybe not your neighbors, but LA,
LA,
San Francisco, people moving to Austin. I'd live in Austin over LA.
Yeah, people are bailing out of LA. Well, they like, it's all dirty now. It's weird. Like they just let
it's a bummer.
Homeless people do whatever they want, and it's just like,
yeah,
I don't know. It doesn't make any.
Yeah.
Anyway, okay. So now, what about other assets altogether? Are you just sticking from A to multifamily, or because you mentioned mobile home parks, you mentioned self storage, all that other stuff? What do you think about those right now, and how do you like those compared to multifamily?
Yeah. So if you say, hey, we potentially see slightly lower returns going forward in multifamily because, the market's stabilized, there's been a huge influx of capital, then where do you find yield, right? You say, okay, what are some other areas of the market that have similar demographics? So self-storage benefits from a lot of the same demographic trends as multifamily, right? You move, you downsize, you can't buy a house, you continue to rent, you put your stuff in storage. Nice thing about storage is if you're paying $100 a month for storage, a couple hundred out there, on the West Coast, if somebody raises your rent 10 or $20, you're probably not going to spend the weekend and move down the street to save $5. We're buying 3 properties currently. They're nearly 100% occupied, right? So there's room to move those rents. So properties like that, high quality, potentially higher cash flow than we see in multifamily, slightly higher returns. Mobile home parks, I would call mobile home parks kind of like almost a subset of multifamily.
Yeah.
So, in my personal portfolio and what we offer to our investors, the mobile homes have taken the place of the workforce housing. And the reason is we're seeing cash flow from those to investors that's significantly higher than the workforce housing and the class A and the luxury properties. But you also see really nice performance in mobile home parks during downturns. So, if you say, hey, we have these nice newer properties, high income renters here, and we have, these properties that take a little bit more work over here, they cater towards lower income individuals, they really balance out each other nice. And then maybe my most favorite asset class of this year are car washes. So there's
Yeah.
there's a big trend. We could dive in there. I could take a pause, but there's some really interesting trends happening in that space, and you can get really great cash flow, really great returns. Obviously, you're buying a business. This isn't just a piece of property that
Right.
you have renters, but we've kind of supplemented our portfolio with some of these other asset classes as well.
So I've been I've been talking to a lot of people about car washes lately, and I just like I don't know if it's just like kind of like out of nowhere. People are just like, wait a minute, this makes a lot of sense. Because I know my buddy was telling me he works for a commercial broker down up in Sacramento, and he was telling me that Quickie Quack is one of their like largest clients. It's like cost them 26 cents or something like that to do a car wash.
Yeah.
And I was like, they're like charging $5 like plus bucks, like if you do membership and all that kind of stuff. He's like, dude, they're killing it. I was like, car washes? He's like, yeah, man. Like they're crushing it.
Yeah, they're cash cows. And my uncle and I looked at buying one about 7 years ago. Actually, it might be longer than that now. So when my partners started looking into the space and, it came up in conversation, I was like, hell yeah, let's do this. And I was like, I said yes to this 7 years ago, but we'd focused on the multifamily so heavily. So the trends that make the car washes appealing, people are less likely to wash their cars right now in their own driveway. You have the rise of the technology of the express tunnel model. So that's where you go and you sit and it takes you a couple minutes and your car gets pulled through the tunnel. It's called an express tunnel. They're actually quite friendly from an environmental perspective. So almost everything is recycled. So the water's recycled, everything's recaptured. So it's a lot better than just washing it down the drain, that flows into your local watershed. That's not good, at home. It's also quick, right? So if I got kids, it's like, hey, if I got kids, maybe I wash my car with my kids, or I make my kids wash my car for me or pay them.
Right.
But if I can drive through a car wash on the way to the grocery store on the way home from dropping my kids off in the morning, and it takes me less than 5 minutes, that ain't bad. And with an average cost of less than a couple bucks to wash a car, and if you can sell a membership for $20, or even higher, in higher cost areas, the profit margins are substantial. And then the final piece is private equity is just now starting to get into this market. So I think there's a 5 to 10 year window where you can acquire a portfolio of car washes and then ultimately exit to these private equity groups that are looking to add these as an option. But it's a limited window of time. So we're building our portfolio rapidly for that reason.
Interesting. So you mentioned the exit. So let's talk about that a little bit.
Yeah.
Are you exiting your properties currently? What's your strategy with that?
Yeah. Great question. So, again, you're familiar with this space. One of the surgeons I used to work with, he always would ask one question when you showed him a new technology, a new implant. He would say, how do I get it out if something goes wrong? Like, how do you remove it from the patient if there's an issue? And the last thing you want to do is provide a therapy to a patient where it could go wrong and there's really no solution, right? So the last thing you want to do is buy a property or invest in something that you can't sell, you can't ever get out of, right? Like that's one of the reasons the stock market and REITs are popular. People can liquidate quickly. It's also one of the reasons why they're so volatile.
Right.
So, from multifamily perspective, we look to exit opportunistically. So look, if we say, hey, we're going to give say a 2x return to investors over a 5 or 7 year timeline, and we can do close to that in half the time, we're gonna exit and do that for investors, give them liquidity. With respect to the car washes, it's or the self-storage, we're building national brands with those products, with those properties. So that may be a little different. We may exit an entire portfolio when it makes sense to sell to a larger group. But yes, we are exiting properties. We do try to line up 1031 exchanges for our investors, specifically with the larger multifamily properties. This year, it's definitely been harder with the rise of interest rates. So we try to be conservative. Our number one goal is to preserve capital. And if we find that we can't find a acceptable property where we're not going to just get rid of something, or we're not going to buy something that doesn't meet our standards. And yeah, I
Yeah.
love how you put this here. Yeah, it's a big frustration. You got to have an exit plan, right?
Yeah. So what is the biggest frustration with your tax deferral in the 1031?
Yeah, so I think there's two things. One, there's a frustration from investors when they say, "Hey, I thought I was going to be invested in this for 5 years, and it's only been 2 or 3, right? And I got this problem where I have to evaluate a new investment." Some investors, we present them with a 1031, and they can do that. Other investors, they choose not to participate. They choose to raise their hand and get their capital back. But then again, the frustration with those investors isn't like, hey, I got to make a new choice for an investment. The challenge is I have potentially a large tax bill, if they have a large gain over a very short period of time.
Yeah, definitely. And so, and honestly, like that's, we love 1031s. I mean, we're Capital Gains Tax Solutions, is the company. So, I mean, we love a 1031 when it makes sense. The problem that we have found is just that, like, you sell high, buy higher 180 days later, So it's just like, we were taught to buy low, sell high, not sell high and then buy higher. Because then,
that's right.
So yeah, and I like how you said that you don't basically compromise your standards because you're under the pressure of a 1031. That's like one of the worst places you can be as a motivated buyer, like
that's right.
And so that's like, we really like applaud you like with that. So, but on the flip side, I'm curious, have you ever heard of a deferred sales trust? Have you ever used a deferred sales trust?
Well, fortunately, I've known Brett for a couple of years now, and I've seen him present at some different events. I've definitely, brought it up to certain investors because, I think, the great thing about a deferred sales trust is it gives you flexibility.
Right.
And, again, I don't, when we sell a property, we don't make the investors enter into a 1031 exchange. We say, hey, here's the property. You have the option to do this. And I just got off the phone with an investor today, and he's going to have a large exit. He's selling some properties, and he's leaving the area that he's got these investments. So he's not going to manage them anymore. Well, he's going to be challenged to find adequate properties for what he's looking for. So for an investor like that says, hey, look, I need to sell these properties. I'm leaving. I can't manage them myself anymore. I don't know if I'm going to be able to find anything over this period of time. Something like the deferred sales trust is fantastic. Or one of my favorite options is for business owners, right?
Yeah.
Say, hey, I'm selling this business and I want to reinvest the money, but I'm just going to take a bath on taxes.
Yeah, no, and that's really what it does. I mean, you can unlock the power of it because it gives you that flexibility and that timing, and it's like kind of agnostic. You don't have to go back into real estate. You sell business, and you can go into crypto if you want, or stocks and bonds and notes. I mean, it's so flexible and so you just such diversification and it's a brilliant strategy. So we absolutely love that, and we have a mastermind every Friday at 10 a.m.
Oh, awesome. I did not know about that.
Yeah. So I'll invite you. So it's 10 a.m. Pacific Standard Time, 11 p.m. or 1 p.m. Eastern Time, every Friday. So I'll throw your email in the reoccurring invite, and when you have time,
please
pop
do.
in, because it's a great, it's a really great environment to just come, ask questions, throw different situations out and so on and so forth. It's phenomenal. So
perfect.
Yeah. So you guys can learn more about that at capitalgainstaxsolutions.com. You can sign up for the mastermind there. And if you want more information about the deferred sales trust and how that works and how it could potentially help you sell a business, sell highly appreciated stock, sell crypto, sell real estate, primary homes, commercial real estate, you name it, anything that's highly appreciated, art, you can sell it and defer all your tax and reinvest. So it's an amazing thing.
Beautiful.
Chris, are you ready for the lightning round?
Heck yeah, man. Let's do it.
Awesome. So Chris, what's your favorite leadership quote?
That's right out of the gates here. So Winston Churchill, he said, never give up. And I used to have that sitting on my desk. Now it's just imprinted in my brain. But I think a leader needs to, I like the servant leader mentality.
Yeah, definitely.
And if your people that are following you know that you're going to throw in the towel and you're not committed, I think then that shows weakness, and you can't expect other people to continue to follow you.
Yeah, no, absolutely. So besides Next Level Income, what is your favorite book?
Great question. So I know we're talking about finances and money here, but the thing that I think about more than finances is health. And money and health are tied together because you can buy a lot of resources that can improve your health. My favorite book that I've read in the past couple of years is called Lifespan.
Mhm.
And it talks about aging is a disease and how it is not inevitable. So look, if you're creating true wealth for your family, figure out a way to extend your life so you can continue to make a large impact on the world. I think that book can help you do it.
Yeah, that's awesome. What are you most curious about right now?
I have two boys, 10 and 12. And really the way that I see my greatest way of making an impact in the world is to raise them to the best of my ability. So I'm continuously trying to figure out how can I be a better parent. And my wife is listening here in the background, and she's probably nodding her head up and down, because it really is a humbling experience.
Yeah, I got 3 of them myself. So
Yeah.
Mine are 4, 2, and 7 months, and they're precious, but they are a lot of work.
Buckle up.
Yeah.
It gets even more fun.
I'm
Every
sure.
year is a different challenge, but even more fun. It's great.
Yeah, I'm
Yeah.
sure. Okay. So, Chris, any parting words?
Yeah, listen, if you're listening here, whether you are looking to make your first investment or you're trying to figure out like what's your next move when it comes to something, reach out, find somebody that's done what it is that you're trying to do, and ask for help. Like, don't wait. Don't be scared. People that have achieved success or have done these things are happy to help you. And that includes me. If there's something that I've talked about today that piqued your interest, you can check out our website, but you can also just reach out to me directly, chris@nextlevelincome.com.
Awesome. And you guys don't forget to go get that copy of that free book at nextlevelincome.com/book. It's called Next Level Income. And it will give you a ton of wisdom on how to go about just making these dreams realities. So nextlevelincome.com/book. You can find it there. Chris, you got a LinkedIn?
I do. Yeah, you can check me out. I think it's just /next level income, no dashes, linkedin.com/next level income.
Cool. So you guys can connect with Chris there as well. And if you guys are interested in the Deferred Sales Trust, want to learn more about that, go to capitalgainstaxsolutions.com and check out our Mastermind every Friday, 10 a.m. Pacific, 1 p.m. Eastern. Come ask questions, bring your professionals, your CPAs, your attorneys, your estate planners, all the people who help make your finances work and go and be smooth. Bring them on board too, and let them dive in. So, Chris, it was an absolute pleasure to have this interview. I really appreciate your time and all of your insights. And so it's just really grateful. So thank you so much. And thanks everybody for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy such as the Deferred Sales Trust or 1031 exchange or Delaware Statutory Trust is the best way to exit highly appreciated assets, create, preserve, and grow your wealth. Please rate, review, subscribe. Hit the like button, the notification bell, share it, comment. Did I miss anything? What else can you do on the interwebs nowadays?
I think you got it, man.
Yeah. Print it out and post it on your sticky wall at work. I don't know. So anyways, all that fun stuff. Thanks again, everybody. And we'll see you on the next time. Chris, thanks again, man. Really appreciate it.
Thank you, Pearson. Great seeing you.